Alrighty, so let's dive into the intermediate trade plan. Now, I do want to say straight off the bat that the term intermediate, it doesn't really mean anything in this regard, as you're about to see as we dive into this trade plan, which you'll already be quite familiar with if hopefully you've watched the course in chronological order. Intermediate, advanced, beginner, they're all, it's like the words aggressive and conservative. They're all relative. It completely depends on where you're at and, how you view things. And this plan we're about to go through, you can make it quite restrictive and just focus on, let's say, the more high probability setups and be a bit more conservative, or you could, really roll your sleeves up and kind of try and trade every phase of the market and use multiple entry models and slightly more aggressive entry models. Manage in different ways. You can make it, more beginner or more advanced or whatever as you want. It's kind of a sliding scale. So yeah, did kind of just want to get that out of the way in case anyone's thinking, is this plan too much to start with or too not or too restrictive? But, I'll try and explain as we go through how you can really mold it into your own, okay? Because that's what we're trying to do here. We're trying to build independent traders, okay, that has your own style, but we give you the framework and then you can figure out with time exactly how you want to implement that within your own approach, okay? So before we dive into the juice of it, let's try and always keep things, somewhat simple. Like we spoke about the high level trade plan at the start of the liquidity 3.0 module, what is it we're trying to do here? We are simply trying to follow that kind of medium time frame / higher time frame order flow, right? Following that higher time frame narrative and then looking for those POIs. So, bearish market, supplies in control, strong highs, weak lows, etc. And then when price comes into those medium time frame POIs, right, we want to look for our lower time frame execution models. So we're playing that medium time frame idea, narrative, POI, but we're just using the lower time frame to help us time these areas, okay? So this trade plan here, you should hopefully be pretty damn comfortable with in terms of this diagram is not new, right? If this is new to you, right, I don't want to tell you off, but go back, watch the course in chronological order and start from the liquidity module where we first introduced this, okay? So this, like I said, you should have already seen this. And I've just added in now those liquidity entry models to the right hand side just so you can have a bit of a cheat sheet and it's all together there for you visually. So like I said, none of this should be new, so I'm not going to spend super long in this specific lesson diving into all of this. You should know in depth what all of this is. So this is kind of just putting it together in one place for you, okay? So depending on, what entry model are you going to trade, where within this phase are you going to trade, that's totally down to you. This is kind of just giving you the overall framework of how to interpret everything. Now, depending on, okay, let's kind of take this first, right? What phase of the market you're going to trade? I.e., are you going to be looking at trading heavily counter trend here? Are you happy to play it when it's pro internal but counter swing? Are you only going to focus on the pro swing portion of the market, right? All of that we're going to talk about in a lot more depth in the following lesson, because I really want to go into that in super depth and talk about like the kind of confirmations you might want to wait for, i.e., are you going to wait for an M15 shock here, or are you happy to get involved straight away in a lower time frame, and all of these things, okay? And likewise, what entry model are you going to trade? That's totally dependent on you. I'm not going to tell you, what you want to do, and some of you will have different variations of these entry models as well, okay? But this is just to give you an indication of kind of how you can lay out a trade plan. What I would say for the most part is you just want to be focusing on the strong liquidation. If you're not sure where to start, even just this one, literally just a fake break, master one setup, and then add in another one. Okay, so that's what I've set up here. Master one before adding the other, and then you can go from there. Okay. So yeah, so the overall trade plan is like, again, we've gone through this in a lot of depth in the previous lessons, so I don't want to spend too long talking about it. But it's pretty much that 3 time frame philosophy. You have your higher time frame, okay, so depending on what approach you want to take, whether you're sort of having that more swing approach and you kind of look at the daily or the 4 hour as your higher time frame, or if you're taking a bit more of an intraday trade, you may want to use the 4 hour as your main higher time frame, okay? So what's the higher time frame objective? Are we playing that pro higher time frame pro trend run, or are we in the higher time frame swing pullback phase? Or are we now in the higher time frame pro trend run, okay? And what does that do? That helps us to signal when our medium time frame may change trend, right? It really helps us to understand how is our medium time frame likely to behave, okay? Because this grey line, as you guys should know, is our medium time frame. And if we've mitigated the higher time frame strong swing low and we've mitigated the extreme demand, then we know it's pretty likely that the medium time frame is about to change trend and probably be quite impulsive, because we're now in what? We're now in that higher time frame pro trend run phase. Likewise, when we're over here, okay, you might be shorting in line with your medium time frame trend, right? Your medium time frame may be bearish and you're shorting pro medium time frame trend. But if you understand that you are counter your higher time frame trend, then you know that two things. One, this bearish medium time frame trend may not last very long because we're just playing the higher time frame pullback into demand. And two, it might behave quite correctively because we're in that, that corrective pullback phase. So when we get breaks of, your medium time frame low, price might pull back straight away, right? It might not be super, super impulsive, because over here, when you're trading, in line with the medium time frame trend, it might be a lot more impulsive, but price doesn't actually pull back that deep. And you might ask yourself, well, why is it behaving in that way? Well, it's because we're in the higher time frame pro trend run phase, right? Whereas back here, we're playing the swing pullback. So your medium time frame might act a bit more correctively, or a bit more tricky. So 3 time frame philosophy, basically, even more simplified, you want to pick your medium time frame. That's the ideas you're playing. They are the POIs you are trading, but then you're using your lower time frame to execute from those POIs, right? So you should be very, very comfortable with this idea. This should not be new to you. This shouldn't be too confusing. That kind of overall philosophy of what we're trying to do, you should be very somewhat familiar with this by now, okay? So again, we're trading medium time frame POIs with our lower time frame execution, right? Once price has mitigated that level, we then look for our initial setup. Those are the textbook bread and butter setups, as I like to call them, that we're doing. Yes, once that's happened and price starts moving down in your lower time frame, you could potentially look for continuations. But until you've nailed this stuff first, this is what your plan is. You want to be doing this, getting consistent with this before you start thinking about that kind of stuff, okay? So like I said, we're going to get into what part of this sort of area you want to trade and what confirmations you're going to wait for. We're going to talk a lot more about that in the following lesson. But yeah, this is pretty much it. 3 time frame philosophy. Have your higher time frame. Know if you're playing the pro trend run or that counter trend swing pullback. Use your medium time frame as your immediate bias. So you're trading from those medium time frame POIs with your lower time frame entry models. Okay. Now, I like to visualize things and have it here, so this is pretty useful. But if you were to have something written in your plan, we've kind of got this overview here, okay? So let's kind of just go through this from left to right. So some of you might want to have this in your plan, some of you might find it totally irrelevant, like it's not something I need to think about, but it can just help you when you're getting started to know, what is your mapping process? When you come to a blank chart, or you come to, your chart to start a new day, a new session, what's the process you should go through? Well, start with your higher time frame, whatever that is for you, right? So that could be the daily, the 4 hour, right? It depends on your plan. What you want to do is you want to start on that, and you just want to map your current swing and internal ranges, right? So we always start with structure. So if you've got a blank chart, you go to your higher time frame and you go, right, where is the current swing range? Map my swing high, map my swing low. And then within that, you want to map your higher time frame internal ranges, okay? And then you can just mark on the premium and discount of the swing range, and you might want to do it for the current internal range as well. Okay, so go to your higher time frame, map your structural ranges. Just the current range, right? You don't need to paint the whole story if you don't want to, right? Just keep the chart nice and relevant. Then within that higher time frame range, right, map on all relevant supply and demand zones, okay? You guys should know how to do that, the ones that meet your rules, and then map on any liquidity sweeps, right? So are there any sweep zones, were there any external range liquidity sweeps, and where is the available liquidity, right? Is there, equal highs, equal lows, trendline liquidity, where, any internal range liquidity left in that range where price could, it give cause for price to move towards that area. And then you just want to set some of your alerts, right? Where's the nearest high time frame unmitigated supply and demand level? Maybe you want to set your alerts at like the swing high and the swing low, just so you can be aware of when price is starting to move. Okay. And then basically once you've done that, then you can start to build a narrative in your mind. Okay. Are we currently playing the continuation or the pullback phase? Because once you've done this, literally just that process there, right? Imagine your high time frame is the 4 hour chart. You would have this thick black line marked, right? That would be your 4 hour swing range. You've got your 4 hour swing high. You've got your 4 hour swing low. You've marked on your 4 hour POI. You've marked on your 4 hour premium and discount line. And now you know where you are, right? You can set your alerts at the POI, potentially set your alert at the swing high and the swing low. And then that's you pretty much done. And then if price is, say, around here, you go, right, we're probably in a swing pullback phase now. And now you know, okay? So what's the next step? As you guessed, drop down to the medium time frame and do the exact same thing. You just mark on what current range are we within? Is there a current internal range to mark? Are we in a premium discount? And just set your alerts, right? Draw on your POIs, do all your liquidity, do the exact same thing, okay? So, like I said, if you've done the higher time frame and you have your thick black lines all marked out, and then let's see price is here, well, then you'll know, okay, this is my medium time frame swing high or internal high, right? This would be the low, mark out your POI, and you go, right, that's where I'm going to look to short, and I'm pro medium time frame trend or order flow, but I know that I'm playing the higher time frame swing pullback, so I'm going to be aggressive in my targets and just target down here, right, down towards this level, and then reassess, right? That's the sort of things you want to be asking yourself, sort of build the story. But the process is literally as simple as start with your higher time frame, mark your structure, mark your supply and demand, mark your liquidity, set your alerts. Exact same thing for your medium time frame, and then it's just a case of when your alerts go off, or you're watching your medium time frame develop, then you drop down to your lower time frame execution, right? Because you're trading medium time frame ideas, medium time frame POIs, and you're just using this as your timing mechanism, right? And then that's when you can refer to whatever it is your lower time frame entry model that you need, okay? I'm not going to explain these because you should be very familiar with these. If you're not, you need to go back to the liquidity entry model or the liquidity concepts module and the putting it all together module, and this is explained in depth, okay? And again, you don't need to have all of these. These are just examples. They're all here. Pick whatever, you probably designed your own entry model, or if you want a starting point, just look at this or potentially both of them, right? That's where I'd always recommend you start with. Regardless of what the medium time frame is doing, just always wait for your lower time frame entry model because strong liquidations is pretty damn solid, okay? So that would be your mapping process. POI selection, so literally just the bare minimum of what you need to be drawing on a POI that you could be interested in trading from is it needs to be a valid supply and demand zone. So there's kind of two methods in which you can do that in terms of actually drawing it. We call it the engulf method or the sell to buy, buy to sell. So what we kind of mean by that, let's talk about the first one, engulf. That's pretty much what at the time of recording I use and what I pretty much use the whole way through the course. And all that means is that you have that kind of that pivot in price and the thrust candle closes above the high or below the low, depending on if it's supply and demand. So what I mean by that, just showing the chart be a lot simple, is right here, right? You've got that candle, that pivot in price. Does the next candle close above its high? Yes, it does. So for me, that would be right your valid POI, right? That would be what we mean by the engulf method. So yes, technically it's not engulfed because a true engulfing candle would break the low and the high of the previous candle, for those of you guys who know that. So it's not really the true definition of engulf, but if you ever hear us say the engulf method for drawing zones, that's what we mean. It means that the thrust candle, if its demand closes above its high, okay? And if it's supply, it would be the opposite, right? You would want to see the candle close below its low, and then you would have a supply zone, okay? So that's what we mean by the engulf method, and that's pretty much what I use. Some people like to use be very strict with sell to buy and buy to sell. And what that means is if it's a demand zone, you only want to draw it on the bearish candle, right? And if it's a supply zone, you only want to draw it on the bullish candle. So some people like to do that. So in that instance, if this doji, imagine that was a bullish candle, but you were using sell to buy, well then you need a bearish candle for demand. So you would always draw your demand zone like that, okay? Another example over here, if you're using the sell to buy method, that's a bullish candle, right? So you can't draw demand on a bullish candle. It needs to be a bearish candle. So you would draw your demand zone like that, okay? That would be the sell to buy method. Likewise, again, you wouldn't draw. So if you're using the engulf method, that would be your zone. I would draw it like that. But if you're using the sell to buy, it needs to be on the bearish candle. So you would draw it like that, okay? This is a perfect example then as well of what I was going to talk about here, which is, do you want to have it in your plan that you only strictly trade pivots? So, the single candle pivot, or are you happy to trade a range? So sometimes what you'll have, right, is like, a bit of a tight range like this, and you might, rather than just refining it to, let's say, imagine this is your medium time frame, right? Imagine rather than refining it to the pivot, you might just because the range is kind of, all in one place, you might want to refine it to the range or not. It's going to depend on how strict you want to be in your plan. And then also the other thing you may want to consider with pivot zones is for the most part, like I always pretty much take the single candle like this, but when you get a thrust candle, like big strong thrust candle like that closes above the highs of, more than one or two candles to the left, then very often I'll just include both of them because sometimes price won't mitigate quite into here. Obviously, in this instance, but sometimes we'll just tap that and go. Okay, so these are things some of you might want to be really strict on and have this defined in your plan that you only trade from pivots and it must be engulfed. Some of you might want to be a little bit more, use your discretion with that. Okay. And obviously the other strict minimum criteria is it must have led to at least some form of break of structure, right? So minimum, it would be a fractal break, right? Because, like back at this point, well, I don't want to draw it, but you guys know this. You guys should be very, very familiar with this, and that it must have broken to, must be a candle that's led to a break of structure. Added additional confluence. Did it flip? Did it sweep liquidity? Does it have inducement in front of it? Is it stacked and nested within a higher time frame zone? So, i.e., your medium time frame POI. Where is it? It's stacked within your higher time frame POI, right? That should increase the probability of that level. Pricing. So, if you ever hear us say pricing, or we just say P&D, we just mean is it well priced? So, if you're buying, it's demand, it should be in a discount, or if it's well priced. Opposite for supply, it should be in a premium. Is it fully unmitigated, right? We want to be trading ideally from zones that have all of those orders left within and they haven't already had a mitigation. Is it part of a chain? Are we seeing a series of mitigations, and can we kind of follow that order flow, right, where you kind of see that and you're saying, right, that was the last injection of demand, following that mitigation, this can increase the probability potentially of that zone. Okay, so that's just kind of a very run and gun idea of how you want to be thinking about your POIs. But if you want to go into a lot more detail, these are the questions you really need to be asking yourself, right? Whenever we say building the narrative, what is the story? This is the art of POI selection. We don't just want to go, okay, I found a engulfed candle that led to a break of structure, so I have my demand zone, and that's it. So now as soon as price comes into there, I'm going to look for my lower time frame execution model, right? No, you need to be doing all of this, and all of this is essentially what this diagram can help you visualize, right? But if you've kind of, let's say price is coming down and you've marked out this this medium time frame POI, you want to be going through these questions like, what is the overall narrative? Am I trading pro trend or counter trend? Am I trading pro order flow or counter order flow, right? So, when you're down here and price is coming in, you might be trading, or here would be a better example, here you might be trading pro medium time frame trend, right? Because it shifted bullish. But, the current kind of order flow, you could have like some clear, strong bearish order flow coming in, and there might be an unmitigated level down here behind. So perhaps you might want to, go, well, let me just wait for order flow to shift. I'll wait for a bullish chock here or whatever, and then you might want to get involved, right? They're the sorts of things you're going to want to, those questions you want to be asking yourself to kind of, help with building that overall narrative. Are we aligned with the higher time frame and the medium time frame? Are they both now bullish, or is one counter and one's bullish? And you have to understand that story. But again, we're going to talk about this a lot more in the following lesson. And then, what's your expectation when price is coming into a medium time frame POI? Are you playing that trend continuation, or are you just playing a reaction for a pullback? So, i.e., when we're coming in here, right, you're aligned with the swing trend, and everything's aligned at this point, and you're looking to basically play that move. You're expecting when price comes into here to at least target that high, right, and potentially beyond. Whereas, let's say, if I drag this across, right, there might be an old medium time frame POI to the left there, and you might want to play that move, right, as price comes in. But what's your expectation at that moment? Well, it should just be to expect you're just playing a pullback into that level, okay? So you're literally just, that's it, right? A reaction for a pullback. They're two very, very different trades. So be asking yourself, what is my expectation of what this POI is likely to achieve? What structure did it break? If it only broke a fractal high or low, is that going to be significant as one that actually caused the swing break, right? That's going to be a lot more significant zone. Did it cause a strong momentum shift? You want to see those zones ideally that really cause momentum to come in. Did it cause a flip? How significant was the zone that it actually flipped? You guys should be very familiar with this. I don't want to talk about this too much in depth. Did the POI take liquidity, i.e. was it a sweep zone? We know if it does that, that increases the probability that there was BFI involvement in the creation of the zone. Does it have inducement, i.e. is there available liquidity? Again, you guys should be very familiar with this now. Is it well priced? Is it stacked within another high time frame zone? Is it part of a chain? Is it completely unmitigated? So is it completely fresh? Does it have a slight mitigation into it? So where you've got multiple levels of candles like this, and you might have a zone like here, right? Oops. And then perhaps, maybe this candle kind of just touched into it. So technically it's not completely unmitigated because there's been a slight touch there, but really it's kind of just price was just like trickling out. So whereas that would be kind of just efficient price action when it was created. So not ideal. I prefer it when it's completely unmitigated, but that's not too bad. And then another one would be like when it was created, we had a movement like this. It kind of just came back in, tapped it and went away. And then if prices, you're still looking at it because only just tapped the edge. If price is coming back, I'd be like, question mark, because that was kind of, somewhat of a decent mitigation that led to a movement. So that's going to be another sort of, question mark around how good is that POI, how many orders are going to be left. They're the sorts of things you want to be thinking about, right? Price delivery to the zone, if you've got a POI down here, and one of the things you want to be thinking of is price coming down super, super aggressively. Now, that doesn't mean you can't trade it, but you need to be taking in all of these questions, like how much confidence does that have overall? And if you're not sure, and if you already have question marks around this POI, and we're coming down with a ton of momentum, then perhaps you just want to wait for a bit more, right? You want to wait for a bit more confidence, whatever that may be, another structure break, etc., etc. These are just questions you need to be asking, and they all need to be considered together. What's being mitigated, right? This helps you really build a story. Always ask yourself that. When price is coming towards an area in which you want to trade, go, well, what's being mitigated? Why is price coming here? Is the objective now likely complete and ready to reverse? Okay, so what do I mean by that? Well, if you are, where's a good example? If you're trying to short here, right? Okay, that could be pro, your medium time frame trend or pro order flow, and you go, right, that on paper, this should be a strong high. This is at the extreme. This should be really high probability. But this trade here, which is pro medium time frame trend or order flow, is very, very different to this trade here, which is also pro trend, pro order flow. Because this one, what's being mitigated when you're getting short? When price is coming up, where is it coming from? It's coming from the higher time frame extreme. The higher time frame is bullish. It's pulled back to this level. It's very likely now this is going to fail, right? Because we've mitigated here. The reason why the medium time frame shifted bearish, what was its objective? Its objective was to facilitate that higher time frame pullback. We've now mitigated the higher time frame strong low, the extreme demand, and now we're coming up. It's pretty likely now that this is going to go. So that's a very, very different trade, even though it's pro medium time frame trend order flow compared to this one, which on paper is also, because you're asking yourself, what's being mitigated? And at this point, when price is coming towards you, well, this has been mitigated. But that's an old level of supply when we're bullish. We just expect it to be a reaction point for a pullback. So that's fine. So we're happy to trade against that. Whereas here, when price is coming against you, well, what we mitigate? We mitigated this. What's the high time frame story? That's a very, very different trade, even though on paper it might look the same. Okay. So always ask yourself what's being mitigated when price is coming back towards you. Who is in control, right? Supply or demand? Again, it's just another way to think about it. Like, the supply zones keep being respected and the demand zones keep failing? Well, then supply is probably in control, right? Are there calls for higher or lower prices? Okay, so you might be trading from a POI, and it could be the level in which price continues, but you might want to think about, is there just going to be a quick reaction, and is there a reason for price to keep trading behind the zone? So, i.e., am I trading from weak structure? Are there unmitigated POIs behind that price might actually want to go and fill before the real move occurs? And is there still available liquidity left that price might want to take out, internal range liquidity within the level? And that can help you. Like, i.e., this trade here could look really good because we've mitigated this level, we've shifted bullish, we've pulled back. However, there still can be calls for lower prices because there could be this unmitigated extreme behind here, right? Because at that moment, that would be the current range, the current medium time frame range. So yes, you might want to get long here, but if this maybe isn't like a decent flip and it didn't sweep liquidity and there's no inducement, but this one is, does have a sweep and it has this inducement, then you need to be wary that, price could come lower before we go. Okay, so again, it's just another thing you want to be thinking about. And again, just all the liquidity stuff, right? Where was the liquidity taken? Where is available liquidity? Like, where is price likely to gravitate towards? Who is being induced? They're all the things that can help you to build that story, to think, where is price likely to head next? Now, this can seem like a lot, again, when you're trying to get your head around this for the first time, but all of these things trust me, you'll get to a point where you just subconsciously, you can almost go through all of that in your mind within about a minute, even quicker. You just see it and you know what looks good and what doesn't. But when you're starting out, these are the sorts of questions you can go through and it can really help you to build that story, right? Because when you probably hear that, like, what's the narrative? It's like, well, what does that even mean? How do I build that? Like, what? This is it. So yeah. But like in terms of like, having it written down in trade plan, you probably don't need to have this all typed out. You can just have something a bit more minimal as you go. And again, some of you, like, this is just an example. This is the written in stone trade plan that you must trade. Like, some of you might only ever want to trade flips, POIs, and you might want to add that in as your strict minimum criteria. It's just, this is what I'm saying, this is the bare minimum. So I would say this has to be true, right? You want to be trading from something that's actually broken structure, and then this can be, you can add in, right? But mold this into your own. Okay, cool. So we've mapped our structure, we've picked our POIs, We've tried to refine them by building the story. So we manage our expectations of what's going to happen when price comes into that POI. So when your alert goes off and price is in your POI, that's when you drop down to your lower time frame execution, okay? And this is where you should have your lower time frame entry models picked out, okay? So don't just rely on this cheat sheet. Like, you need to know what one are you going to test, what's the exact one in your plan, what are you trading? Are you just trading this? Are you trading both? Are you trading 3 or 4 of them? Are you trading all of them? Do you have a different variation to ones I've drawn here? Do you have your own rules? Like, you need to have that extremely well defined so you know exactly what lower time frame entry model you're going to use and when and how to trade it, okay? But for a more sort of generalized, rule, like how I would have it in my plan, it's just, I know I'm waiting for that medium time frame mitigation, and then I wait for my entry model, and then I would set my entry order. This again, you want to decide, are you going to be a trader who always sits on the edge? Are you going to use 25%, 50%, or the body, right? We spoke about this in the entries module, so go and look at that if you don't know what I'm talking about there. And then stop loss always behind the zone, and you may want to add, be consistent with how much of a buffer you have for your spread, right? So you might always want to do like 0.5 pips behind the zone plus spread, or whatever rule you may want to use, okay? But generally, when price comes into a POI, it's kind of the rhyme that goes through my mind. Medium time frame mitigation, liquidation, V-shape, chalk, okay? So really kind of these 3, you don't really need them written there because they are taken into consideration in your entry model, right? So for some of you, you might not use a liquidity entry model, so you might not need this, but I'd probably recommend that you do. So, they're the questions I'm asking myself. Once I get that medium time frame mitigation, I know with any of those entry models I'm looking at, right, liquidity must be taken before the entry. Ideally looking for that V-shape, right? All that means is I just want to see momentum, out of your zone. You just want to see like, those orders being filled. And I always need a chalk at the time of recording, right? So, but like I said, those 3 lines should be taken into consideration in your entry models anyway. So you might not need these 3 actually written down. But yeah, so, I can take a risk entry, I'm going to take a confirmation entry, and what entry models do you use? You want to know and have those exact in your plan, and how you're going to enter on the POI, and where you're placing your stop loss. Now, trade management, again, there's so many ways you can skin a cat with this, right? It's going to totally depend on your psychology, your overall trade plan, how aggressive you are, where you're trading, what works best for you, your lifestyle, your commitments, right? Go back and look at the management lesson, and then we kind of talk about the general ways in which you can do that, and you just need to experiment and figure out what's best for you. Probably, if you just want to have something really simple and get going and get wins on the board and get consistent and remove the decision fatigue of when you're actually in a trade and you've done all the hard work with this and you're in, what we usually say is just target 5R. Fix 5R, or maybe if you're entering maybe a little bit of a higher time frame, like you might just want to go fix 3R. Like just get a bit consistent, keep it mechanical, keep it easy in the psychology. You're in the trade. You might not even want to move to break even. It's either plus 3R or plus 5R, and if you lose, it's minus 1R, right? Just keep it nice and simple. And then as you get better and more advanced with all of this stuff and the entries and where you're trading, within the diagram, within here, then you can start to think about like, okay, getting a bit more, a bit more varied with how you want to manage things. So I've kind of just given a bit more of an intermediate example here, but like if you're trading pro trend and pro order flow, you're typically expecting a bigger move. You can typically target a bit further. So you might just want to go with fixed 10R. If you're trading counter trend and counter order flow, and you're just trading a swing pullback or an internal pullback, you might just want to be a bit more in and out, okay? But again, it's going to be very dependent on each individual scenario. Is there enough risk reward? How tight is the range? What's in the way? So yeah, but these are kind of like the general idea of sort of what can work quite well. And don't be super strict. Sometimes if there's a super key level at like 8R, just take 8R, right? Don't push past it just for the sake of it because you have to be super mechanical. But some of you might want to. And again, how are you going to remove your risk? Are you going to leave your stop loss open? Are you going to use partials to partial out your risk? Or here's an example that I kind of you might want to use, which is trading to break even after the break of the lower time frame pullback. So i.e. your lower time frame entry model, right? And then you get your chalk. Obviously this is not an entry model, but if you just had a chalk and then you wanted to get long here, as price pulls back, you get tagged in, you would set your break-even line there on your lower time frame, right? And then you would trail. And you're either going to trail straight to break-even, or perhaps you want to trail behind that first initial lower time frame strong low, just in case price comes back in, you don't want to get tagged out, and then it goes. Okay? So again, not going to it's beyond the scope of this lesson, but there are sorts of things you want to think about. How do you want to have that in your plan? And then lastly, risk management. Again, this is just suggestions. Modify them as you see fit. Don't hammer us with questions in the Discord about all of this. Should I do this? Should I do that? Like, you need to use some initiative and decide for yourself what works for you. If you just want a starting point, here it is. I would recommend definitely something like this. Have a max 3 losses per day. You don't want to go on tilt and undo your hard work. 3 strikes and you're out. You're gone. Leave the room, turn your computer off, come back the next day. risk 0.5% per trade. Again, totally independent on your risk appetite, your data, your strike rate, what you want to do. It's up to you. I would say probably don't ever go less than 2 pips, just because it's just silly. The commissions are stupid. Slippage risk is just way too high. Like, I would have that as an absolute minimum. And then, this is always people find this a bit of a funny one, but you should write in your trade plan what instrument or multiple instruments you actually trade, because you'd be surprised at how many people they go, oh yeah, I only trade euro dollar. And then they get a bit bored or whatever, and then maybe it's a bit of a slow week, or they see someone post a chart on Aussie dollar or USD yen or whatever, and suddenly they've taken a trade. But have you tested that? Have you planned? Have you been following it for a while? Do you have a good read? No, you just got bored and you punted into another pair, right? So it's invalid if you take a winning trade on another pair that's in your plan. That's an invalid trade, and you should not do that, right? So make sure you are actually super strict and you're being disciplined here and you're being professional. List what you have tested, what you're trading, and what you are risking your hard-earned capital on, okay? Be professional. And again, I do not want to get flooded with questions about this, about high-impact news, but you might want to have a rule in there in your plan about if you're trading on the M1, you're probably not going to want to trade into high-impact news, so you might just want to have a blanket rule of I'm not going to take any entries before then. If you're trading on the M15 or higher, perhaps maybe you're happy to trade through it because your stop loss isn't going to be as small. But then you might want to say, okay, if it's a rate announcement or CPI or whatever is, moving a lot, if you notice the last few months, those certain high impact news announcements have big movements in the market, then you might want to adjust that, okay? So again, I'm going to leave that down to you, what works best for you. And again, sessions, right? If you're trading on the M1, M5, this is going to be a little bit more important, and you might want to have fixed sessions. So the London session, as we call it, 7 to 10 a.m. London time, or New York, and again, 12 to 4. It's just recommended hours. These are not, you need to figure out what works for you. When can you actually be on the charts? When you start to backtest, just pay attention to those. Some of you might find at 5 p.m. you still find loads of trades, right? Some of you might find in the London lull between 10 and 12. You're more than happy to trade them because you can get winning setups, okay? These are not the golden key. It's just recommended guidelines that might help you, okay? Likewise, if you're a bit more active on the M15, you kind of have a bit more of a swing approach, you might just want to trade the whole day, right? London lull might not be as negative on your strike rate as it is on the M1, okay? So there's no secret key to when you should and shouldn't trade. Obviously, they're trading the London Open, New York Open for sort of those textbook setups is a key area in which you may want to be active on the charts. But there's so many of you in here who live all over the world, who can only be in the charts at certain times. So pick the times in which you can actually be executing, and then go and test those times and see what your edge is, okay? And then this will be defined by you. Okay, cool. So yeah, I didn't know exactly how to do this lesson because you should be pretty familiar with this diagram and this overall approach and the philosophy and the lower time frame entry models, because we introduced this at the start of the Liquidity 3.0 module, and we've worked our way through it and putting it all together. And I've just put them both on one chart. So you should be very comfortable with this, or at least the theory and the understanding of it, okay? Now, depending on what you want to start with, i.e. what entry models and things like that, that's going to be down to you. But like I said, I've given you some recommendation. Start with just this, or maybe both of them. Master it, get very comfortable with it. And if you want to add in more, or you've got your own entry model that you've found or what works for you, add that in, okay? Use your own initiative. Back yourself, trust yourself, right? Don't use us as a crutch. We've given you what I think is a pretty damn amazing starting point. You need to mold it into your own and trust yourself, right? Use some initiative. You've got this, okay? It will come with time. And then in terms of management, like I said, it's very, very down to you. When you want to start pushing for bigger targets, it's going to come down to how experienced you are with really reading and understanding the higher time frame narrative. And, so that's why when we say start out, just get wins on the board, fix 3R, fix 5R, and then over time you'll realize, okay, if I'm trading here and there's loads of risk reward and everything's aligned, probably doesn't make sense to be taking all of my profits here. But that will come with time, okay? So in the following lesson, we're going to talk a lot more about the different phases, how to approach that, what confirmations to wait for, and we'll try and get a little bit more advanced with it. But if you want some walkthroughs, go back through the liquidity module and putting it all together, and there should be tons of that in there for you.